Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over information from Twitter. We're going to cover a wide array of different things: commodities, real estate, used cars, go over everything. And I'll give you my financial opinions. My opinions may differ from other people. They are 100% wholly my own. I do disagree with, we'll say, a wide variety of people because I think people are too, well, not everyone, but some people they're too, if prices go down, they're too bearish. Prices go up, they're too bullish. I stick to themes. I stick to theses. I stick to things where I have to get convinced for me to be otherwise. I need to see the data. I need to see some sort of something for me to change my mind. And some of this I'll go over in this clip and give you my opinions around it. Based off of what I think is the data and whatnot. And I could be wrong. No one's, no one is 100% right, but at least you get my viewpoint when I give these comments. And again, if you guys need any help with anything and you want my viewpoint even further, you can definitely sign up to finding-value.com. We do have a community over there, and we do weekend sessions either on Saturday or Sunday. And you can ask me whatever you want, and you get to hear my opinion even more specific to what you want me to talk about. So let's dive in here. And again, if you want to follow me on here, it's at finding_finance. So it says, which market is stickier? In which market it's more difficult for new supply to be created? It says housing or cars. People expected used car values to crater back towards pre-COVID norms. They fell from peak, but they're holding much higher. Expect this for housing as well. So what he's saying is it's easy to bring to market, or easier to bring to market cars. The response time and lead time for cars is much shorter than homes. And the weird thing is we've got this gigantic move higher. You can even see the three waves almost, 1, 2, 3. 3 waves higher. We've come on back, and it is expected to kind of stay up there. Now, the question is, are we going to get a further pullback in this? It is still very well possible. And I'm not necessarily a used vehicle value expert by any means. And this does look a little bit fishy with these guys continually going higher. But I can say this. If you look at the pullbacks, we had a pullback in the recession of 2001 to 2002-3. The commodity bull market also did that same thing. Commodities came down, they took off in 2002, and then you could see used car prices also took off all the way to about 2007 and rolled on over. Gigantic move back down with the 2008 crash, basically followed the entire market. In 2020, it had a little crash, moved on higher, and maybe this is all we get for a pullback. Maybe what is coming is much more inflationary than what most people can imagine. And I'm not saying that that is going to be 100% the case or the fact. What I'm trying to say is, well, what if that is? What if this chart is now on a certain, if you were to put a trend line on here, and you trend line this all the way through, and now we're at a trend line which is much steeper and much higher. What if we're going into an inflationary period that people are not expecting at all? Maybe that is the case. Maybe it's not. But I can tell you this, we've had a pretty big run up, and we've got a pullback, and we're starting to run back up again. That is something to take notice. Now, another thing to take notice is a lot of the times when they do crash, you're going to get a sucker market where this comes back up. What it's called is a bull trap. We don't know if this is a bull trap where it rolls back over and comes back down, or if we're going to extend this to the upside and this is just wave one. Now, what I would think and what I'm going to guess is that it's a wave one, wave two, and then we're going to get a wave three that comes way on higher. Then that means that it's from an inflationary pressure in the system. But that's me guessing. I don't know that for a fact. We need to see more evidence. We need to see more data. We need to see what transpires over the next months and years. So this is something that we're watching, and it is going on up recently. So this is the headline translated. It says, Fed uses badly lagging data to justify over-tightening and causing a worse recession than necessary. And my question about this headline, not about Adam, but just the headline in general, okay? The question is, what if they're not? What if the data that they're looking at, what if it's not justifying an over-tightening? What if they're looking at separate data where they're like, holy crap, we've got a problem? What if they are scared of something that is coming that we, as investors or retail investors or whoever's outside looking in, what if we have it wrong and they have it right? Now, I'm not saying that is the case. I am just bringing up data or an argument saying that maybe they're looking at something different than we're not seeing. And maybe they're like, holy crap, we got to get interest rates way higher. I think that, XYZ is coming. I don't know, but I'm just giving you an opposite opinion here. And I'm kind of on the opposite opinion. I think that maybe something bad is coming, and I've positioned for that bad thing, which is high inflation. So I want to go through this thread here. It says quality investing is one of the best investment methods in the world. Knowing how to identify these companies is a must. Learn how quality maestro Terry Smith does it here. So let's dive in. So Terry Smith is known as the Warren Buffett of Great Britain. He's the founder of CEO of Fundsmith. He's returned 15.5% to shareholders. This means an investment of $10,000 would have grown to almost $70,000 over his time leading this investment. So he did this utilizing a very simple framework. Buy good companies, don't overpay, do nothing. And that resonates with me. This do nothing and buy good companies resonates with me. And I mean, obviously we chase value and we don't want to overpay, but it says it's really that simple. But let's dive further into it. So 1, buy good companies. A good company is high quality if it has high returns on capital employed, competent and ethical management, a sustainable competitive advantage, and plenty of reinvestment opportunities. So rather than investing in the next big thing, Terry wants to invest in companies that have already won. So Terry Smith's portfolio is filled with high-quality companies including Microsoft, Alphabet, Amazon, Pepsi Company, Estee Lauder, Adobe, and Nike. I've also done this type of investing. The ones that I choose that have already won and are just expanding their market share are companies like United Health Group, Anthem, Blue Cross Blue Shield, and they were now Elevance, I think. MasterCard, Visa. These are things that I see in everyone's wallets continuing to gain market share that I've invested historically in. It says the return on capital employed, ROCE, of his portfolio is 32% versus just 18% for the S&P 500. This shows that the portfolio is very high quality. The reason he solely focuses on quality companies is simple. Quality companies outperform the market. So that's what he goes after. Quality companies, outperformance. Then it goes to number 2, don't overpay. Even the highest quality companies can be poor investments if you overpay for them. Valuation matters. It says in his latest annual letter, Terry explains that despite the Fundsmith portfolio being much higher quality, the free cash flow yield is similar to the S&P 500. So not only does he own higher quality companies, but those companies are also trading at a valuation similar to the market. And number 3, this is one of my favorite, do nothing. This is how you make money. You get into the companies and you have to literally do nothing. If you do something, you screw the investment up. It says in order for companies to grow, the last ingredient is time. Time is the friend of a wonderful company and the enemy of a mediocre one. Put time on your side by buying and holding great businesses. Terry Smith is also very vocal about the importance of understanding stock-based compensation. Tech companies in particular have been prominent examples of using stock-based comp to attract top talent. There's nothing wrong with compensating employees with shares. In fact, there is a legitimate reason for doing so. It can help align the interests of employees with those of shareholders. The problem is that stock-based compensation can optically boost the non-GAAP earnings and free cash flow of a company. In other words, many companies try to overstate their earnings by excluding stock-based compensation. The bottom line is that stock-based compensation is a real expense. Thus, when you calculate free cash flow, you'll want to subtract out the stock-based compensation to get a more accurate earnings figure. Don't ignore this. Value investors can be tricked into buying cheap companies that turn out to be value traps. Even if you pay a high price for a quality company, the growth of the business over time can make that company look cheap in hindsight. Sometimes it's good to pay up for quality. How growth could become value and value didn't. And they talked about some of this here, and some of this is a timing issue more than anything. It says in 1973, you could have paid 281x multiple of L'Oreal and would still have beaten the market. You could have paid a 126 times earnings for Colgate and a 63 times earnings for Coca-Cola. Over time, great businesses compound, and slight differences in returns make a huge difference over time. So for example, consider this. Company A compounds it. We have these three companies. They compound at 10, 12.5, and 15%. After 30 years, Fund B will do twice as well as Fund A, and Fund C will do 4 times as well as Fund A. This is why paying up for quality works over time. The secret with quality companies is that they break the law of mean reversion. When a company earns excess returns, it tends to revert to the mean. The returns for quality companies don't mean revert. Thus, the company continues to earn high returns on capital employed. The end. Want to learn more? Terry's book, Investing for Growth, contains all of his annual shareholder letters. We mapped them in one PDF for free on our website. So that's what we've got there. I do agree very much with this guy's approach. And if you take a very long-term time horizon, obviously those that can compound a higher interest rate are going to do much better than those that don't, irrespective of what you think the value is in that particular time frame 10, 20 years ago. So we'll keep moving on. It says URNM broke out above the blue line and is now back testing. Inflection point right here. I agree. URNM and a lot of the uranium companies are very close to a breakout. And hopefully you guys have been patient. You're doing nothing, exactly like Terry is saying. And we have held on and let this thing give us eye-popping returns for a while. Fingers crossed. Hopefully that all works out like that. It says Case-Shiller Home Price Index was just released for December. Home prices were down 0.8% on the month nationally. Over 12 months, the home prices rose 5.8%. So a year over decline occurs below the bold zero line. So it hasn't happened yet, but we are coming back down. And I do suspect that we could get very close to zero in the March, April, May timeframe, because that's when we've seen the slowdown in price appreciation and the year over year calculation catches back up. So March, April, May timeframe, I do think this could go to close to zero. Now, this is from Rob. He says, we are in the least affordable housing market in at least the past 25 years, possibly longer. Expect real estate prices and rents to come crashing down before all is said and done. Well, I'm going to take an opposite approach. And this is why I'll take an opposite approach. So if this is increasing affordability to the top and decreasing or worse affordability down here, one thing that we could say is, why is it down there? Why is the affordability that low? Now, part of it is from home prices, and the other part is from interest rates going to such high levels. But I will say this, if the market had the worst shortage in the history of the world, let's say the shortages were really, really, really bad, what would you see in affordability? Well, if the shortages were incredibly bad, we would see the least affordable house prices or housing affordability ever. So the question is, does that cause a crash in homes? In my opinion, it does not. So I disagree with him that it's going to cause like a blowout crash. Now, I'm not saying that that prices can't come down. That is not what I'm saying. What I'm saying is the prices can remain resilient and they can remain elevated, and the demographic and the shortage of homes will keep that price higher. The affordability will impact prices to some extent, but I don't think that it's going to come crashing down, perhaps, that most people think. And the reason I don't think that is because affordability is a function of supply and demand. And I see nothing here talking about supply and demand. It's a one-sided argument. So they're saying, oh, affordability is really bad. Now, could the interest rates impact the price because the interest rates went up as fast as they did? 100% agree with that. But I don't think we're going to see like a blowout crash as we did in 2007, 8, and 9. And the reason is because I think that the demographic is there to support it. So if we did get a slowdown in house prices, and we did get a slowdown in the housing starts, and things started to slow down, I think the interest rates would come back down, the affordability would get better, and house prices would remain resilient. That is my take on it. Could I be wrong? Yes, I could be wrong, but that's been my take, and it's been my take like that for a while. And the thing that would change my mind about the affordability and a crash is I would change my mind if we saw a gigantic boom in housing starts, they overbuilt, and we came into a supply glut. Then I would completely change my mind. But I don't think that can happen very easily. I think it will take a long time. So that's my take there. Now here's another one. It says, your daily reminder that velocity is meaningless. And what he did is he took money velocity, which is coming on up, and then he is comparing that to the 12-month percent change in consumer price index, which is coming back down. But the consumer price index and the velocity of money are not a direct correlation. So what they're doing is they're sucking money out of the system from financial assets. The Federal Reserve is. They're sucking it all out. That's why we're seeing mortgage rates go up so fast. They're stopped doing QE. They're unloading their bonds. They're unloading everything, right, on their balance sheet. That's going to impact financial things. The velocity of money is going up, but we've got a couple of things that are basically colliding with each other. A QT, or quantitative tightening, and then we also have money in the system that's circulating. So they're yanking money out of the system through QT, which is impacting financial assets. Velocity of money is still out there, and that is also having an impact on the consumer price index and on money in the system. It just means that the money in the system is circulating. Now, if you take money that's really not out of the system, but it's considered to be in the M2 money supply, that could also impact velocity. So QT could be directly related to velocity as well. And you could see from 2000 that they really started to print here, and you can see that dive in money velocity. It's money that's not going into the system. It's not creating transactions. It's financial money, not real market money. Well, if they're yanking financial money out, it's not going to impact the real market as much. And that's why there isn't a direct correlation to that inflation in the system. But if you've got less money in the system circulating faster, and this remains pretty resilient, it is actually helping the consumer price index because you're yanking M2 money supply out of the system. And this can still go down, but it's still having an impact. It's not a zero impact. And no, they're not directly correlated. I wanted to touch on that. It says, here we go again. Oil is at an important level, close to a short-term breakout. The recent upward move in the 10-year yield and copper is likely a prelude to a significant rise in West Texas intermediate prices in the near term. And look what we've got here. He's got a simple trend line. He's just running it down, and we're about to break to the upside for oil prices. There's other things that I also look at that are fractals that also point to where oil could move to the upside as well with fractal analysis. basically the way that this thing fell and is compressed matches the way it fell last bull market in commodities. So, and yes, we very much have the 10-year yield and copper moving up, which has definitely historically been a prelude to oil prices moving up as well. Now, here's the dollar. So, looking at things priced in dollars like oil and these other ones, we look at the bearish wedge break, and what we've got here is we've got the bearish wedge. This is the DXY, the US dollar currency index, and it's broken to the downside. If we look at a potential top here, we could be seeing a head and shoulders topping pattern with a neckline that is broken to the downside from a short-term perspective on the US dollar or DXY. So we could see a move lower in the dollar here in the short term. And I agree with that when we do our daily technical analysis. And another couple of things I want to touch on. Being very early and being wrong look exactly the same 99% of the time. Very true there. It says, Peter Lynch, you have time on your side when you own great companies. It is not on your side when you have a 3-month option. It is not on your side when you are on margin. And my investing methods are not good for options and using margin. They are good for this type of approach where you buy something very cheap, and these companies are typically very levered, and you can get very big returns without much leverage. So I'll end it there, guys. That's where I'm seeing in the markets there. And I think there's a lot of good information in this clip here. Maybe you should watch it again. Be careful how you're choosing your companies. Great companies are the ones you want to lock into and hold on to for very long periods of time. So right now, we're looking more at commodity companies just because that's what's in cycle. That's what I think is coming. That is based off of the real estate cycle, the business cycle. It's also based off ratio analysis and technical analysis, and they all kind of match together, signaling that we should be looking at those companies at this time. But you can obviously hold onto whatever companies through a very long period of time to get those great returns with the companies that these guys are selecting. You don't have to invest in it only during a certain period, although that can work too. But you can also hold on to them for the rest of your life, so to speak, that Buffett and all these guys do. So if you guys like the content, give me a thumbs up. Subscribe to the channel if you haven't already. We'll catch you on the website if you'd like, and we'll catch you next time. This is Finding Value.